Hey viewers, welcome back to Quick Invest. Today topic is continuity from previous video AI bubble, about AI bubble catalyst and timeline. We predicted a painful, yet necessary, 30% correction in the AI market, but when is it coming? This correction won't be caused by a single, random event. It will be a planned, predictable failure to meet an impossibly high standard. We will map out the most likely timeline and triggers in late 2025 and early 2026. Crucially, we will dissect the $455 billion counterparty risk, the hidden financial strain that could turn a simple correction into a market-wide scare. Trigger 1, the earnings shock timeline. The most likely correction window centers around Q4 2025 and Q1 2026 earnings reports. Why then? Because the market currently demands accelerating growth from these tech giants every 3 months. The catalyst: watch for Nvidia's late 2025 report or Microsoft, Google's Q1 2026 reports. If they deliver an earnings beat, but the forward guidance is merely in line or slightly below the consensus, the stock will get hammered. That's because an inline projection signals growth is slowing from its exponential pace, something the current valuation simply cannot tolerate. It will be a guidance shock, not a revenue miss, that starts the dominoes falling. Trigger 2, the macro headwinds. The other major trigger is macroeconomic. The market is pricing in a Goldilocks scenario, AI growth plus falling interest rates. If inflation re-accelerates in late 2025, forcing the Federal Reserve to keep interest rates higher for longer, that entire scenario flips. Higher rates immediately reduce the present value of future earnings. For stocks like Nvidia, which are valued almost entirely on future growth, this means an instant and mechanical re-rating lower. Additionally, any increase in global trade tariffs or major geopolitical instability could raise the cost of hardware and supply chain risk, directly hitting AI company margins. The counterparty risk chain. Let's talk about the ecosystem chain effect. This is the hidden financial strain. The whole AI boom is based on a chain of massive, long-term contracts. Cloud providers, like Oracle and Microsoft, sign multi-year, multi-billion-dollar contracts with AI developers. Oracle, for example, recently reported an astounding $455 billion in contracted backlog. The strain on the chain. That massive backlog is great for investor confidence, but it requires a huge upfront investment in data centers and Nvidia hardware, known as capital expenditure, or CapEx. Oracle is facing questions about how to fund this enormous build-out, especially since their near-term free cash flow is negative. This is the core strain. They are spending now for revenue that is years away. The strain gets worse because these are often single customer commitments, like the rumored $300 billion deal underpinning much of Oracle's confidence. The counterparty crash. This creates an enormous counterparty risk. What happens if AI adoption is slower than expected? What if a major AI startup customer pivots its strategy, or, worse, goes bankrupt before the multi-year contract is fulfilled? The cloud provider is then left with underutilized, expensive infrastructure and a broken revenue stream. A public announcement that a major AI customer has scaled back, deferred payments, or defaulted on one of these huge contracts would send an immediate shockwave through the entire ecosystem, breaking the chain and accelerating the correction. Conclusion. So, the triggers are clear. A failure to maintain an impossible growth rate during Q4 2025 earnings, a negative shift in the interest rate environment, and the materialization of counterparty risk in the multi-billion-dollar AI infrastructure contracts. These are the pressure points to watch as the market approaches its reckoning. Thanks for watching. If you find the video useful, it helped me to create more content by liking and subscribing to my channel. Disclaimer: information in this video is provided for educational purpose only and should not be considered as financial advice. Always do your due diligence or so speak to licensed financial advisor before making investment decisions.